here's a quick story about a trucking company, a pile of traffic fines, and a tax deduction that hit a legal wall. Tank Truck Rentals, Inc. MV, Commissioner of Internal Revenue, 1958. Welcome to Once Upon a Case, because the law isn't just for lawyers, it's for everyone. Set the scene. A trucking company runs heavy tankers across state roads. To hit delivery targets, some trucks exceed state weight limits. Police issue fines, lots of them. At tax time, the company tries to deduct those fines as ordinary and necessary expenses of doing business. The IRS says no. The tax court agrees. The case climbs to the U.S. Supreme Court. Here's the core issue. Are fines for breaking the law deductible as business expenses under the federal tax code? The company argues these are routine costs of a tough business. They're predictable, they're connected to operations, and deducting them is just accurate accounting. But the Supreme Court isn't buying it. The court holds no deduction. Why? Because allowing a tax deduction for a penalty undermines public policy. In plain English, if you can write off fines, you reduce the sting of punishment, and that weakens the law those penalties are supposed to enforce. Think about the incentive. If every illegal overweight run becomes a bit cheaper after taxes, it's easier to treat fines like a toll. The court says the tax code shouldn't subsidize unlawful conduct. That principle, don't let taxes erode public policy, became a cornerstone. Even though the statute at the time didn't list every non-deductible bad act, the court read ordinary and necessary through the lens of public policy. In other words, necessary doesn't include, help me profit from breaking the law. Let me boil this down with the promised recipe. 3 facts. 1. The expenses were state-imposed fines for violating truck weight limits. 2. The company treated them as business expenses and tried to deduct them under what is now Section 162. 3. The Supreme Court said those fines are non-deductible because allowing the deduction would frustrate a strong, clearly defined public policy, enforcing highway safety laws. One key, tax rules don't just tally costs, they reflect values. If a payment punishes unlawful behavior, the tax code won't help you soften the blow. This ruling didn't come out of nowhere. Before and after, courts wrestled with where to draw the line. Not every distasteful expense is banned. For example, in a later case, the court allowed legal defense costs for a securities fraud defendant because the expense itself didn't violate public policy. It funded the constitutional right to a defense. But fines and penalties? Different story. They're the enforcement tool. Congress eventually codified the point even more explicitly. Fines and similar penalties paid to a government for law violations aren't deductible. That's now embedded in Section 162F. So what does this mean for businesses? If it's a punishment for breaking the law, don't expect a tax deduction. If it's a compliance cost, like permits, safety gear, or lawful fees, that can be deductible. If it's gray, say settlements, details matter. Who you pay, what it's for, how it's labeled, and how the law treats it. Paperwork and allocation clauses can make or break deductibility. Back to Tank Truck Rentals. The company's day-to-day reality, tight schedules, heavy loads, and competitive pressure didn't sway the court. The bigger picture did. Roads have limits for safety and infrastructure. A tax deduction that normalizes violating those limits blunts the penalty and harms the policy. There's also a fairness angle. If law-abiding competitors bear higher costs to comply, and violators get after-tax discounts on fines, the market tilts toward the rule breakers. The court's rule tries to keep the playing field level. Thank you for watching. If you find this case interesting, please like, subscribe, and ring the bell for more. See you on the next one.